Every day there's a new piece of evidence that hits the news, and most of it's been fairly unfavorable. There's been a lot of criticism of corporate governance of banks, and it was interesting to note in the Silicon Valley Bank that only one of their directors actually had any background in banking. So not hard to figure out why there were bad decisions being made. Another thing that happened was Comerica was added to the regulator's watch list. This is problematic, I think, for borrowers in Michigan and also Texas and California, where they have a big footprint also, is that Comerica is a strong middle market bank. And if they have any liquidity shortcomings that impact their Tier 1 capital and ability to hold on to middle market credits, that will certainly have an impact on businesses going forward. So we're cheering for Comerica to pull out of this because we want a vibrant middle market. The other issue, I think, is real estate, both the industry and the financing, which is integral to fueling the real estate market. I think there is going to be a natural push to make financing tougher, if for no other reason, that real estate is typically financed over a longer term, which by its very nature means that it'll be a less liquid asset for financial institutions to hold. So I fully expect that there will be a downturn both in real estate prices and real estate activity, which has been pretty hot lately. If you look at it, it's the supply of houses really isn't large because the demand has been so great. Demand will be there, but I also think that prices may start to fall as people find it harder and harder to get financing to transact. BlackRock's Larry Fink came out in the last day or so talking about that all the government's easy money really fueled inflation. And as a result, he believes that it'll be hard to stop inflation below a 3.5% to 4% rate over the next few years. I think most government sources have been saying that they fully expect inflation to be 3.5% to 4%, but they expect next year it'll go back to 2%. BlackRock, who controls a lot of the financial markets, is saying that they don't believe that this is possible, and this will be a phenomenon for the next 3 to 4 years. One of the interesting things that has caused a lot of the illiquidity in the marketplace is really the need for higher returns by a lot of financial institutions, endowments, and people who partake in financial instruments. And so as a consequence, there's been a move towards a lot more illiquid investments to get those higher returns. I know having sat on a foundation board in the old days, I'll say 30 years ago, you often had 60% of assets in equities, 30% in bonds, and 10% in alternatives. And today, if you look at a lot of endowment investing, approximately 80% are in hedge funds and private equity funds because the yields typically in equities and bonds haven't been real strong over the last few years to maintain levels of return that are needed for payouts, either to retirees or beneficiaries of endowments and foundations. So they have traded liquidity for yield, and I think it'll be close to watch whether or not the trustees and fiduciaries of these types of organizations have properly matched liquidity with the types of investments that they need. So I think the big question going forward is this just the start, or are we going to see this come to a peaceful end here shortly? I am guessing that we are just witnessing the start.